In the last couple of days, Bitcoin dropped under $62,000, its lowest level since February. At the time of filming this video, I woke up this morning and it's actually closer to 60,000. In a single 24-hour stretch, roughly $1.5 billion in leveraged positions were wiped out. That's more than 200,000 individual trading accounts, which had their active bets forcefully closed by cryptocurrency exchanges. Something that would have happened because they ran out of the funds required to keep those bets open. And almost immediately, a single explanation took over the conversation. Michael Saylor sold 32 Bitcoin. That's the story going around. Whether it's the right story to pay attention to is a completely different question. And honestly, a lot of things have been happening. So today, I want to walk through what we actually know, what the data shows, and a few of the ways that people are trying to explain this Bitcoin dip. Let's start with what's not even being disputed, the numbers. So Bitcoin fell below $62,000. Across the broader crypto market, somewhere between 1.5 and 1.8 billion in leveraged positions were liquidated in 24 hours. Live data from CoinGlass showed that Bitcoin positions made up over 800 million of that liquidation, and Ethereum another 386 million. Quick explainer, because this matters for the rest of the video. A lot of crypto trading happens with leverage. You put in a little of your own money and you put in a little borrowed money. Sometimes you put in a lot of borrowed money. And when the price drops against you past a certain point, the exchange force sells your position to cover the leveraged loan. That's a liquidation. And when thousands happen at once, all the forced selling pushes the price down further, which triggers more liquidations, and this can cause a snowball. So now that we've covered a bit of what has happened, the harder thing that I want to get into is why it started in the first place. The explanation that spread the fastest was Michael Saylor and the 32 Bitcoin that his company sold. And it seems to have the greatest psychological effect on a lot of people. But Strategy, the company formerly called MicroStrategy, which is the largest corporate holder of Bitcoin in the world, they filed a disclosure showing it sold 32 Bitcoin in late May, about $2.5 million worth, at an average price of around $77,000. And for a company whose public identity is built on never selling, their stock dipped 6 or 7% after that event. But before any investors panic, know that Strategy holds more than 843,000 Bitcoin. So those 32 coins are a relatively tiny fraction of their pile. And the company has said before that it will occasionally sell amounts to cover dividend payments on one of its financial products. So by the raw math, this could look like a small pre-planned sale. And the question is, does a small sale explain a $1 billion plus move for Bitcoin? That seems to be where opinions are split. You've got one camp saying there's no chance because the dollar amounts aren't remotely close, and the market just seems to have used Michael Saylor's face to put on as a mask over its fear. Another camp argues it's less about the dollars and more about the symbolism. That one of the biggest crypto Bitcoin believers going and selling anything would be enough to waver confidence in the crypto market. But honestly, outside of that entire conversation, there are some other things going on that I also think we should be looking at. First, US spot Bitcoin ETFs, the funds that let regular investors hold Bitcoin through a brokerage now, those funds saw money pulled out for more than 10 days straight. One of the longest withdrawal streaks since they launched in 2024. Estimates of the total range from around $1 billion this week to roughly $3 to $4 billion over the full streak, depending on the window that you measure. But either way, it's a steady drain happening underneath the Saylor headline. Second, the Federal Reserve hasn't been cutting interest rates the way markets were hoping. Inflation's been stickier than expected, and when safer assets like bonds pay well, the most speculative stuff tends to get sold first, and Bitcoin sits at the speculative end. On top of that, there was geopolitical uncertainty in late May around US-Iran tensions, which tend to make investors pull back from risk across the board. And third, Saylor himself and a research firm called Presto Research have pointed to where money's been going, into AI. By Saylor's numbers, capital markets put something like $400 billion into AI infrastructure over 6 months. Just 6 months. That's chips and data centers getting financial backing while a few $1 billion outflowed from Bitcoin funds. The argument here is this is a rotation. You have big money chasing a hotter theme, not abandoning crypto and not deciding that it's actually unimportant or whatever. But crypto is not really getting all the hype today. AI is the hot topic. Presto found that through 2026, Bitcoin dips kept lining up with rallies in AI and gold. And I want to be clear that this is a theory, and it's one with an interesting messenger. The person making the whole "don't worry, it's just a rotation" argument is also the person holding the most Bitcoin. That doesn't make him wrong, it's just definitely worth keeping in view. So what do I actually think that happened? I'll give you my read, and I'd ask that you hold it as loosely as I do, because I'm just a random guy on the internet. And aside from the fact that I'm literally an investment advisor, I'm not your investment advisor. But nobody, myself included, has a crystal ball that lets them know exactly why what's happening is happening right now. Now, if I had to point at the thing that I think might matter the most, I'd point at the leverage and the ETF outflows, the boring structural stuff. I'd point at that more than any single headline. The market was crowded with borrowed money bets, the steady institutional money was quietly headed out the door, and the macro environment gave everyone a reason to be cautious. In that setup, you don't really need a villain. You just need a spark, and the Saylor news may have been that spark, rather than, a full-on fire. And I don't know that. And be cautious of anybody posting too confidently about their economic opinions online, because markets are messy and you don't know these people online. And the honest version of analysis is usually these 2 or 3 things that probably contributed a lot, rather than this is the one explanation. This is what happened. Now, earlier, I mentioned this idea of AI rotation. Money rotating out of crypto and into AI, from old hype to new hype. Well, the same AI boom that may be pulling money away from crypto right now is starting to tangle up with crypto in a couple of unexpected ways. One is physical. AI data centers are desperate for electricity, grid-connected, permitted, large-scale power. And it turns out Bitcoin miners are sitting on a lot of that. So some miners have started leasing their facilities to host AI computing instead of mining coins. Van Eck noted one of the steepest sustained drops in Bitcoin mining power in its history is partly because of this. The infrastructure built to run Bitcoin in some cases is being rented out to run AI. The other way that crypto and AI are tangling up right now is a bit stranger. The Bitcoin Policy Institute ran an experiment where they asked dozens of AI models across thousands of scenarios what kind of money they would choose if they were running their own affairs. Most of these AI models leaned towards digital native money over traditional currency. Bitcoin for long-term holding and stable coins for everyday payments. A new model. Now, I would take that with a grain of salt. It's a single study from an organization with Bitcoin in its name, and an AI preferring something is not the same thing as us people deciding to use it. But it's a generally interesting question about where we might be headed in the future. So here's what I'll leave you with until next week. Bitcoin lost $1.5 billion in a day. The popular story blames selling 32 Bitcoin coins from one company, which mathematically is preposterous, but psychologically in the news, maybe. The fuller picture probably includes leverage unwinding, institutions pulling out, a cautious macro environment, and a massive amount of money flowing towards AI instead. And I don't know which of those mattered the most, but they're all there for us to observe and have thoughts about. An interesting note I picked up while researching for this video: historically, Bitcoin is wildly volatile with 70, 80, 90% drops. However, recent research shows that with the adoption of Bitcoin ETFs, volatility may be decreasing. That would mean the distance between the peaks and the troughs are compressing together. So we might not see the same frequency of insane volatility that we've seen in the past. I just think that's interesting. If you are someone who's waiting for Bitcoin to go back down to 10,000 or 15,000, and by all means it could, I think the sort of thing that you're really trying to do is along the lines of pattern recognition. And I think that the patterns people are picking up on is potentially a shrinking of that volatility, and that we actually might have a reason why the creation of Bitcoin ETFs. So I wanted to share that with you. And I hope that in this video, I could lay out a bunch of individual pieces of a picture and a bunch of opinions and let you weigh them to draw your own conclusions. I don't know much. I'm an internet random guy. And honestly, even though I'm a financial advisor, that doesn't mean that I have a crystal ball. It just means that I want to present things to you in a balanced and fair way and try to have your best interest at heart. Again, it doesn't mean that I know everything. That's a crazy notion. But week after week, I'm gonna be researching things and trying to share what I learn. I'm gonna try to grow in my knowledge about economics and investing. And if you want to grow alongside me and learn, subscribe for another video next week. Finance and productivity content weekly. I hope to see you there.